Hello everyone, I'm Joey and welcome back. Let me ask you something. Have you noticed that your money seems to disappear faster than it used to? You go to the grocery store for a few things, and somehow the bill is much higher than expected. You fill up your car and the number on the pump keeps climbing. You look at your rent, your insurance, your electricity bill, your restaurant bill, and eventually you start asking yourself, what happened? Why does everything feel so expensive? Here's the strange part. You may be earning more money than you were several years ago. You may even be getting raises. So why doesn't it feel like you're getting ahead? This is where the story gets interesting. Because the answer isn't simply inflation. Inflation is part of the explanation. But there is a much bigger story happening underneath it. And once you understand it, you'll understand why prices can stop rising rapidly and still feel incredibly expensive. Let's start with the biggest misconception. When people hear that inflation is falling, many assume prices should be falling too. But that's not what inflation means. Imagine you used to pay $100 for your weekly groceries. Then prices increased by 8%. Your groceries now cost about $108. The following year, inflation falls to 3%. That doesn't mean your groceries go back to $100. It means they're increasing from approximately $108 to around $111. That's a huge difference. Lower inflation does not mean lower prices. It simply means prices are rising more slowly. And this is one of the most important reasons people can feel like the economy is still expensive even when inflation has cooled. The price increase already happened. And unless prices actually fall, you're starting from that higher level. Think about it like climbing a staircase. Inflation determines how quickly you're climbing. But once you've climbed several steps, slowing down doesn't send you back to the bottom. And that's exactly what happened to everyday prices. Now think about something you buy every week. Groceries. You probably don't calculate the inflation rate every time you walk into a supermarket. You simply notice that your shopping cart seems to contain less, while your receipt seems to contain more. And groceries are particularly noticeable because you buy them constantly. A $5 increase in something you purchase once a year might not matter much. But if dozens of everyday products become more expensive, the effect becomes impossible to ignore. Milk, eggs, meat, coffee, snacks, bread, soft drinks, all those little increases accumulate. And here's where your brain plays another interesting role. Humans don't experience prices like spreadsheets. We remember certain prices. You might remember when a fast food meal cost a certain amount. You might remember what your favorite coffee used to cost. You might remember filling your gas tank for a price that seems impossible today. Those memories become reference points. So when the price rises significantly, your brain doesn't just see the new number, it compares it to the old one. And that's why a price increase can feel emotionally much bigger than the number itself. But groceries aren't the only problem. Let's talk about housing. For many Americans, housing is one of the largest monthly expenses. Rent, mortgage payments, property taxes, insurance, maintenance, utilities. Even when one of these costs stays relatively stable, the overall cost of keeping a roof over your head can still be enormous. And housing has another effect. When housing becomes expensive, it doesn't just affect your home, it affects everything around you. Businesses have to pay rent. Workers need somewhere to live. Restaurants have property costs. Stores have operating expenses. And when businesses face higher costs, they have to decide what to do. Sometimes they absorb them. Sometimes they reduce expenses. And sometimes they raise prices. That's why inflation isn't just about one product becoming expensive, it's a chain reaction. And that brings us to something even more important, your paycheck. Because prices aren't the only thing that matter. What really matters is the relationship between your income and the cost of living. Let's say your salary increases by 4%. That sounds pretty good. But what if your overall expenses increase by 6%? Technically, you're making more money, but your purchasing power has fallen. You're earning more dollars, while those dollars buy less. And this is why someone can honestly say, I'm making more money than ever, but I still feel broke. They're not necessarily imagining it. The number on their paycheck may be higher, but the cost of maintaining their lifestyle may have increased even faster. And there's another part of this story that most people don't think about. Some expenses don't just rise because of inflation. They rise because the entire structure of the economy is changing. Insurance is a perfect example. Insurance companies have to account for things like accidents, medical costs, repairs, severe weather, property damage, and the cost of rebuilding. If those underlying costs rise, insurance premiums can rise too. So even if you personally haven't changed anything, your bill can change. Your car is the same. Your house is the same. Your driving habits might be the same. But the economics surrounding those things aren't necessarily the same. And that leads to a very important question. If so many everyday costs have increased, why hasn't everyone's income increased enough to compensate? That's where the story gets even more complicated. Because the economy isn't one giant machine where every price and every paycheck automatically move together. Different prices rise at different speeds, different workers receive different raises, different cities have different housing markets, and different families have completely different spending patterns. Someone who spends most of their income on rent experiences the economy differently from someone who owns a home. Someone who drives 50 miles every day experiences gasoline prices differently from someone who works remotely. And someone with children may feel grocery inflation much more strongly than someone living alone. So when someone says, "The economy is fine," and another person says, "Everything is ridiculously expensive," both people can genuinely believe they're telling the truth. They're experiencing different parts of the same economy, and we're not done yet. Because there's one expense category that can quietly make almost everything else feel worse. And it's not groceries, it's not gasoline, it's not even rent, it's the cost you don't always see immediately. But that can take a huge bite out of your monthly budget: debt. And when we combine higher prices with credit cards, interest rates, housing costs, and monthly payments, that's when the feeling of being financially squeezed becomes much easier to understand. And that's where we'll pick up next. Debt. This is where things can get even more complicated. Imagine your rent has increased, your grocery bill is higher, your insurance costs more, and then you have a car payment, a credit card balance, student loans, or other monthly payments. Suddenly, even a decent paycheck can feel like it's disappearing before the month is over. And here's the key difference. A higher price doesn't hurt only once. If your grocery bill goes up, you feel it every week. If your rent increases, you feel it every month. If your insurance premium increases, you feel it every month. And if interest rates are high, debt can become more expensive at the same time. That's why people can feel financially squeezed even when the economy is technically growing. The economy can be expanding, while your personal budget is getting tighter. And that distinction is incredibly important. Because when economists say the economy is doing well, they're looking at huge numbers: GDP, employment, consumer spending, inflation, productivity. But you don't pay your bills with GDP, you pay them with your paycheck. And that's why the question that really matters isn't simply, is the economy growing? It's, is my income growing faster than the things I have to pay for? That's a much more personal question, and it explains why economic headlines can sometimes feel completely disconnected from everyday life. You might hear, inflation is cooling, unemployment remains low, the economy continues to grow. And then you open your grocery receipt and think, that doesn't feel like my economy. And honestly, that's because there's a time difference. Economic statistics can improve before households actually feel relief. Prices don't have to keep increasing rapidly for families to continue feeling pressure. They simply have to remain high. Think about a person who used to spend $2,000 a month on essential expenses. Now imagine those same expenses cost $2,300. Even if inflation slows dramatically afterward, that person is still starting from $2,300. Their financial reality has changed, and unless their income catches up, that higher baseline remains. This is one reason the word affordability has become so important. The question isn't always whether something is more expensive than last year. The real question is, can people still comfortably afford it? That's a completely different measurement, and it applies to almost everything: housing, cars, groceries, healthcare, insurance, restaurants, travel, even entertainment. Now here's another reason everything can feel expensive. Convenience. Modern life is incredibly convenient. You can order dinner from your phone, get groceries delivered, stream movies, subscribe to dozens of services, have packages arrive at your door, call a rideshare in seconds. The problem is that convenience often comes with recurring costs. One subscription might not seem like much, another one doesn't seem like much either. But suddenly you have several monthly payments leaving your account automatically. And because the charges are small and recurring, they can be easy to ignore. That's a completely different experience from making one large purchase. Your brain notices the large purchase. It often ignores the small recurring ones, until you add them all together. And this is where the modern economy becomes fascinating. Businesses aren't only competing to sell you products, they're competing to become part of your monthly budget. Once a company becomes a recurring expense, it can generate revenue from you again and again. And the more recurring payments you have, the less flexibility you have when something unexpected happens. A car repair, a medical bill, a higher insurance premium, a rent increase. Suddenly the problem isn't just that one thing became expensive, it's that your budget was already full, and that leads to one of the biggest lessons from everything we've discussed. Feeling like everything is expensive doesn't necessarily mean you're imagining it, but it also doesn't mean every price is increasing at the same rate. Different expenses behave differently, and different households experience inflation differently. That's why your neighbor might say they're doing fine while you feel like you're constantly falling behind. You may have different housing costs, different transportation needs, different debt, different income, different family expenses. The economy is the same, but the experience isn't. So what can you actually take away from all of this? First, don't confuse slower inflation with falling prices. If inflation falls, prices can still remain at the higher levels they reached previously. Second, pay attention to your purchasing power, not just your salary. A bigger paycheck isn't necessarily a better financial situation if your essential expenses are rising faster. Third, look at your recurring expenses. Subscriptions, insurance, debt payments, memberships, bills that automatically come out of your account. Sometimes the biggest financial leaks aren't the things you buy once. They're the things you pay for every month without thinking about them. And finally, understand that the economy isn't just something happening on television. It's happening every time you fill your gas tank, every time you go grocery shopping, every time your rent changes, every time you receive a utility bill, and every time you decide whether something is worth buying. That's what makes economics so interesting. You don't need to be an economist to understand it. You're already participating in the economy every single day. And now I want to hear from you. What's the one thing that feels dramatically more expensive to you than it used to? Is it groceries, rent, gas, insurance, restaurants, or something completely different? Write it in the comments. Because your answer could actually help show what people are feeling in the real economy, not just what the headlines say. And if you enjoyed this video, subscribe to the channel. Here we break down the economy, money, prices, businesses, and everyday financial decisions in simple language without making you feel like you need an economics degree to understand what's happening. Because the economy isn't just about Wall Street, it's about your wallet, and if you've ever wondered why your money doesn't seem to go as far as it used to, now you know. It's not just one thing, it's the combination of higher price levels, changing costs, housing, insurance, debt, purchasing power, and the everyday expenses that quietly add up. The economy can change slowly, but you feel those changes every time you spend $1. Thanks for watching, and I'll see you in the next video.